Well, this was a good result for Westpac. We saw good growth in our businesses in terms of loan growth. The profit was up 26%, so very strong in terms of our profit growth. 12% when you exclude some of the notable items, so a very strong year from a profit perspective. We saw some expansion in margins. We did see an increase in impairment charges. But when we look at the customer broadly, they've been able to react to the harder conditions, to the inflation and to the interest rates. So that's been a positive thing. But we do end the year with just over 13,000 people in hardship arrangements. That's well below COVID levels, but up off the bottom. So overall, a good result from the perspective of the P&L. And then in the balance sheet, it's the strongest I've seen in my career at Westpac. So we have a Common Equity Tier 1 ratio of 12.4%. That positions us very high in a global context. And with that strong balance sheet, we're able to both increase the dividend and announce that we'll be doing a buyback of shares of $1.5 billion. So a strong balance sheet also means that we're well set up to fund growth, fund investment in the business, and if we have excess capital, further returns to shareholders. Over the past few years, we've been focused on portfolio simplification. So we've completed that this year with 10 business sales. So that's a good milestone for us. We're now moving into the next phase, and that's another important phase for the bank. What we're aiming to do is reduce technology components by 2/3. So a very big simplification of technology for the bank. That'll improve our employees' lives because that'll make their jobs easier, if you like. It'll also improve customer experience, which is critical to compete in the market. And we'll also reduce costs off the back of that simplification. On the economy, I've always said I'd rather be in Australia than any other part of the world. We've seen a slowdown in activity as higher interest rates and inflation's really come through. So we are seeing less spending by consumers. We are seeing less demand for loans, so there's less activity. But pleasingly, the unemployment market has held up pretty well. So people are still employed even though activities are down a little bit. For us, we expect going forward still good demand for mortgages and business lending, not as high as what we've seen historically, but certainly growth. So that's a positive. The interest rates we'll have to wait and see, but there's certainly a lot of demand in the economy from energy transition, from the infrastructure spend, from the houses we need to build. So that is putting pressure on demand in the economy and probably going to mean interest rates stay at the levels or maybe even a little bit higher than what we've seen historically. So that will be a drag. But the big thing to watch is employment and productivity and how we go. So at the moment, the slowdown's gone broadly well on average. We're seeing the majority of our customers being able to handle this slowdown. So pay-to-head rates in mortgages are pretty similar. Mortgage offsets actually grew in the half. The number of people with credit cards making minimum repayments is pretty stable as well, so that's good. And I put that down to the labour market, people having jobs, people being able to get extra hours, and of course they've cut their spending. But I would say if there's any customers that need help, please call us early.